Welcome back to another episode of Any Given Quarter. I'm your host, Ali Jaffrey, Chief Economist and Partner at KPMG Canada. Today is August 4th. Of course, we have to timestamp things these days. And we have yet another banger of an episode for you today. We're going to be taking a deep dive into the U.S. economy and trying to think through what's going on at the Fed. And to help us do that, I'm joined by a very special guest and someone I'm honored to call my colleague, Diane Swong, Chief Economist of KPMG USA, our big sister firm. We don't have enough time to properly introduce Diane and her long list of accomplishments, but the high-level summary is Diane is an absolute legend. Some very brief highlights for you guys. She's been with the firm since 2022 and is a leading commentator in the national media on U.S. economic issues. She's served as an advisor to the National Economic Council. That's the forum that advises the White House on U.S. and global economic policy issues. Diane regularly briefs the regional Fed Reserve presidents and the Board of Governors in D.C. She's interacted with Fed chairs all the way back to the late Alan Greenspan, and we'll get to that in a bit. And she's provided congressional testimony on different economic issues. She was recently named by Barron's as one of the 100 most influential women in U.S. finance for 2026. And she was honored by her peers as fellow of the National Association for Business Economics for outstanding contributions to the field. Diane is also a past president of NABE. Basically, Diane has done almost everything and most importantly, knows everybody. So we're so pleased and honored to have Diane. Welcome to the podcast.
It's great to be here, Ali, and my admiration for you is equally high. Thank you. I feel a little humbled by all of that. I think it's just that I've been around for a very long time.
We're so happy to have you on the podcast. And so let's just jump right into this. So we had Q2 GDP last week. We have the payrolls coming on Friday. Why don't you lay out for our listeners, what's the state of the U.S. economy and where is it headed?
Well, a lot of people took the GDP report at 1.5% to be, it's this weakening economy. It was down from 2.1% and demand must be slowing. This is a big problem. The Fed should be cutting. Some people were actually arguing that. But in reality, the reason we saw that 1.5% was the trade deficit widened dramatically because we were importing so much in terms of inputs into data centers. And in fact, domestic demand in the second quarter was almost 4%, 3.9%. That's really a stunning, real inflation adjusted demand. Not only did consumer spending accelerate quite sharply, bouncing out back after a very weak first quarter, that's in part because we had fiscal stimulus that helped to ameliorate some of the effects of higher oil prices at the pump for many consumers. We had a lot of tax refunds, the surge in tax refunds during the quarter, but we also had the tailwind of monetary stimulus at the end of 2025. Remember, we saw 3 rate cuts by the Fed at the end of 2025 and a total 1.5% rate cuts since late 2024. And that sort of gave us a little bit of a tailwind coming into this year, along with, of course, just the AI boom is ongoing. And the wealth that it creates is continuing to support consumer spending as well. We're expecting the employment data on Friday to still look very solid. You don't need as much in terms of employment gains to have the unemployment rate stay low right now. Underneath the hood, there are some signs of stress in terms of the new grad unemployment rate is much higher than the overall unemployment rate now. And that's really a reflection of the low hire, low fire economy that we're in. We don't have a lot of churn, healthy churn in the labor market. That's important. But new college grads, what's also important is why they blame the fact that they're not getting as many jobs. They don't blame it on the low hire economy. They blame it on AI. 89% of all new college grads think that AI is taking their job. That's important because it's getting more than its fair share of the blame. It's being scapegoated, much like immigration and trade was earlier in our cycle and in the election cycle. That's important because that's not the reason, but the backlash is showing up across the board in terms of states that it's going to show up on the ballot in November in terms of managing AI data centers and also regulating AI by state and local governments.
So that leads us nicely into kind of this AI discussion. Like many people have argued that the U.S. economy is sort of this one-legged economy being propelled by, this massive AI boom. But we're seeing firms and equity markets in particular start to question what are the returns going to be from this? So what are your thoughts on that? What are you hearing from firms? And if we can kind of try to peer into the future, how do you think that AI is going to impact the labor market of the future? We already see this angst that you described amongst, younger workers, but also what is it going to mean for future productivity?
Well, I think, there's a lot of things going on there to unpack. First of all, almost every single innovation we've ever seen, major technological innovation, the build out of the capital infrastructure needed for that has precipitated a bubble. And I think that's not surprising. We saw it with the tech bubble, we saw it with railroads, we saw it with electricity, we saw it across the board on different kinds of technologies that have really rocked our universe. And AI is an incredible technology. It does require an extraordinary amount of capital investment to the extent that we actually see it crowding out other kinds of investment. There are some spillover effects into the broader manufacturing sector, everything from HVAC equipment to the machinery that goes into the data centers, but a lot of it is imported and in fact comes under tariff waivers. It's not tariffed because it's considered a strategic initiative, part of the defense build out as well by the United States. And I think that's going to be important going forward and adding on to this AI boom. There is a slowdown in the pace at which these data centers are being added to the economy. We expect it to slow but still contribute to growth in 2027. And it's starting to slow to the pace at which revenues are rising. That's good news for some of the AI companies, but it still is a work in progress. And, whenever you have something like this, it's easy to get ahead of the actual payoff and the scaling of productivity growth across the overall economy. The costs and the wealth effects are landing first, and those have consequences. And our greatest risk for the economy is, of course, a correction in the AI boom. If anything were to happen that derailed that AI construction activity, you would see a much weaker overall US economy, both because of the slowdown in capital investment and because of the spillover effects to wealth effects. The problem for the Federal Reserve is the sequencing of AI. It takes a while for those productivity gains to hit. And what we're starting to see now is some new research that suggests that, in fact, it's not going to eliminate all jobs, as some people in Silicon Valley thankfully had predicted. It's not quite the Armageddon. Part of that is a policy choice, of course, but also what we're starting to see is AI does better. In fact, when people have critical thinking at KPMG, we train new interns coming in critical thinking to use AI so that it's not being used just as a dumb tool. It's a smart tool, but it's also used by people who have an education and can level up those who don't have an education. So it's not clear that it's going to destroy as many jobs as many people had feared, which is, I think, the good news, even as it helps out on productivity growth in a world where we have significant curbs on immigration and an aging population. And so we're going to need some productivity growth to continue growing and to support that population as they age. So I don't see it as quite as catastrophic as some people do right now. I think it's getting more than its fair share of the blame. And I think that's partly due to the fact that we've not really addressed many people's individual concerns. And the social contract is important whenever you're dealing with a new technology. You want to deal with how people experience it and also how they feel about it going forward. And what does it mean to have a data center in your backyard? All of those things need to be addressed, and that is going to be coming to a head, I think, in this election year.
Yeah, I know. I've always said that go long on AI, but be patient. That we don't really
Exactly.
understand the bottlenecks that we're able to solve with this. As Dan, as you and I know, like the key to economic growth is ideas and solving bottlenecks. That takes
Yep.
a little time. We saw with the technological boom in the 90s that yes, it was quite strong, and GDP growth in the US in particular was elevated as it was in Canada and other advanced economies. But really, the benefits of those technological changes took decades,
Decades and decades.
right?
Remember the Stolo paradox, right?
Exactly.
1997.
Right. Now,
Yes,
the
that's
benefits do come, but they've been distributed over time. I'm
right.
not saying that AI is going to take as long as it did in the 90s. It may be sooner. Everything I've been reading books from the 2017 to 2019 era on AI, and they predicted these things would take a decade or more. They took a little bit less than a decade. So you know, faster than expected, but we're not seeing transformative change, as you mentioned. You know, I know some disciplines are seeing that, but it's not broad based.
No,
And I think
it's very individual. And I think individual firms, and you make a really good point on that. I just want to dovetail on that, Ali,
yeah,
that this people don't count the fact that the length of time it took to get the cloud up and
yeah,
running. You would not have AI without that as well. And I think oftentimes when they're looking at this condensed time frame, and you really made a good point about it, is that they're missing that it took a lot of groundwork that was laid first before we could even get to this point that we use these models, let alone that we adopt them in an economy-wide sense that actually lifts productivity growth.
exactly. And so, you know, I'm not pessimistic about it either. But I worry, as you do, about the market reaction. That if you have a major correction in the equity market and have large negative wealth effects, that, you know, it affects high-income households' purchasing decisions. You know, they've been really pushing the consumer spending in the U.S. So I think there's good reasons to be concerned about it. I'm not hitting the panic button at all, but I think there's a need to be balanced about the outlook for AI. And I expect over the next year, and curious to hear your thoughts, that firms are going to recalibrate. I don't know if we'll get a big correction, but I think we'll get an adjustment.
Yeah, and that's what we're all waiting to see, is how big it will be and how much of the risk. But you make a really good point. I mean, unfortunately, the downside, I think, to the U.S. economy is also how much high-income households have been carrying economic growth. Inequality is very high. Income inequality hit its trough in 1980. We got a brief period in that latter part of the 1990s when productivity gains that we had during that decade were shared, and you actually saw a narrowing of income inequalities. But wealth inequalities in particular have really widened out when you've got the top 1% of households accounting for over half of all equity and mutual fund holdings in the United States, the top 10% accounting for 89%, and the bottom 50 somewhere between 1 and 2. That's just not a good situation. And it does make us more vulnerable to exactly what you're talking about. If the wealth effects were to diminish, along with the ability to finance these major data centers through the equity markets and through debt markets as well, because they're now issuing debt. And there's some pushback on that, right? A higher premium for some of that debt. That is going to slow the build out and the adoption as well.
Yeah, absolutely. And I would say to our listeners here in Canada that a correction in the US equity market is going to have important implications here too, because Canadians and their TFSAs and their, you know, RSPs, equivalent to 401ks in the US, they hold a lot of U.S. equities, as do non-financial corporates as well. And that's probably a story globally. So, so there's some important global spillovers that would emerge from that. And obviously a slowdown in U.S. demand is going to impact trade between Canada and the United States as well. So very important to watch. And I agree, that's the number one risk. I would pair that also maybe with worries about U.S. fiscal policy, but I guess we won't go there for now. Let's turn to inflation. A big challenge, you know, as you described, you know, an economy that's doing well, at least a cyclical uplift on a fiscal sugar high, at least in Q2, plus the AI boom. We see underlying inflation even before this energy price shock at 3%. Like you, I believe, Diane, I was surprised that the Fed cut rates in 2025, given underlying inflation was 3% then. We're a bit above that now. So walk us through this, unpack the inflation story and the risk from the energy shock, from trade policy, and the tech build out. And if you can, if you have some numbers about where you think PCE and core PCE will be by the end of the year, you know, that would be great too.
Sure. So first of all, you know, the inflation issues, you know, many people say, I hear it all the time, well, these are just one-time shocks. You look through them. The look-through shocks, those were in the 2010s when we had no inflation, decelerating inflation. We had energy prices going up because China was the largest buyer on the margin of energy prices. And you could look through it because not only were inflation expectations well anchored, nobody expected inflation was not the norm. In fact, disinflation was the norm. And we were the Federal Reserve was trying to get inflation up enough to have enough sort of grease in the US economy to keep it going. Now what we have is shock after shock after shock. At the same time, we've had strong demand. You put the two together and it was combustible, of course, in 2022, where we had that searing bout of inflation. But it's important the context at which the continuing shocks are occurring. We've had over 5 years of inflation from various reasons. You can cite all kinds of reasons, but only one institution is charged with derailing inflation, and that is the Fed. And it's now gone on for over 5 years. There is a sort of normalization of inflation going on. Firms are gaining a muscle memory. They know what it's like now to raise prices when they have to. And we have these shocks keep coming. Now, the additional tariffs that the administration has put in place to make up for the tariffs that were ruled illegal, those have just kicked in. They're not going to add a lot more to inflation, but the energy crisis with regard to the Strait of Hormuz is far from over. That will have some residual impact. We could be still seeing numbers in the PCE by the end of the year around 3.5 to 3.75%. That's well above where we are today in terms of the overall inflation rates and well above anything that's considered price stability for the Fed. And remember, even once we get to the Fed's target of price stability on the PCE, which currently right now is the PCE index of 2%, it still takes time for people to feel like they've regained the ground lost to inflation. And it's not just these external shocks, it's service sector inflation, which, that, as you made the note of, actually showed signs of being sticky and elevated and entrenched prior to one shot being fired in the Middle East. And I think that's very important to remember as well, because in January and February, we still saw these elevated and an acceleration actually in service sector inflation. And that's the part of inflation that shouldn't have been affected by things like tariffs. That should have been sort of the part that was cooling as the labor market cooled. And we did not see that. And we still don't see it today. And I think that's where you're seeing the concern with the Fed. We saw only the fourth time since 1992, three presidents actually voted to dissent on the vote to not move rates. They wanted to raise rates at this meeting. And that's important because that was only Kevin Warsh's second meeting on the job. To have that many dissents at your second meeting on the job, I don't think that's exactly what he had hoped for.
No, I don't. But before we get to the Fed, I just want to unpack one piece on the inflation part. And it's the argument I hear often that, okay, yes, we have underlying inflation at 3 or a little bit above 3, but we had this tariff shock that's running through the system. And so that those effects on the level will start to dissipate. The New York Fed, I think, and some researchers, the Fed governors have kind of put some numbers around that are being widely circulated in markets. And that the energy price shock, although we kind of have a ceasefire, not a ceasefire, we're still sorting this out. Even if energy prices remain in this kind of range of $70 to $100, the arithmetic of inflation is going to have this fall off sooner rather than later, is the argument. And that we could, when we get through these shocks, actually be close to 2%. And I've heard that from several market participants that they think, when you abstract from elevated goods prices, even and energy prices, even though you have service prices that are a little higher, housing is not adding much, and that underlying inflation may not be that far from 2%. How do you respond to those types of arguments?
So I've heard them as well, and I disagree with them in the sense that, first of all, we know post-pandemic that an economy we've gone from uncertainty being episodic, sort of like a storm that comes, we clean up after the damages and it's over, to a fog. And I think that's really important that it's now endemic. So a high level of uncertainty coupled with a lot of shocks and that slow erosion of the context of 5 years, over 5 years of getting used to inflation becoming the norm. We know that post-pandemic, that tends to make for more fertile ground for a more persistent bout of inflation. And I think that context is really important. You can't go back to looking at these shocks as one-off events because they compound with each other. And even the way that the tariffs were rolled out, they were rolled out in phases that mimicked inflation itself. And so that normalizing of inflation, that muscle memory of inflation is very important. And bottom line is strip out shelter costs, which have been cooling. We still have over 3% inflation in the service sector, and that's over half of the US economy. You can't have price stability unless you have a lot of deflation elsewhere. And this is prior to many of the costs that are still in the pipeline with regard to AI. That is the bid up in the cost of memory chips, the increase in costs in consumer electronics. We don't know exactly how those will be adjusted for the quality adjustments associated with AI, but nonetheless, we know that many of those price hikes are still in the pipeline. So I think it would be sort of negligent to not deal with the current situation. But the other part of this argument within the Fed at the moment, in the debate within the Fed, is our current rates with the pickup in productivity that we've seen. It's not been enough to actually take away inflation. And in fact, it justifies a higher rather than a lower neutral rate. Now, this is not what the Fed chairman has argued. Coming into the position, he had hoped that higher productivity growth would alleviate inflation from AI and then take down the neutral rate. That's not what history has told us. And in fact, the 1990s, we saw a pickup in the neutral rate, in fact, because productivity growth had picked up. And so many people within the Fed think right now they went too far. And I agree with that on rate cuts. And that's part of the reason we're seeing the stickiness in inflation today.
I completely agree. In fact, 2 years ago, I was arguing that there's no way the neutral rate in the U.S., this is the long run anchor for monetary policy, where the overnight policy rate in Canada or the Fed funds rate should be in the long run to keep the economy in balance. I didn't believe that it was anywhere near the pre-pandemic level.
Right.
And look, we've had private domestic demand in the U.S. between 2.5% and 3% for 3 years now. That predates the AI boom.
Yep.
The labor market has been.
And now it's stronger.
Yes, it's stronger. We're going through another cyclical uplift. Obviously, fiscal policy is pretty loose, being charitable. So when you add it all up, there's scope for neutral to be higher because capital stock is higher, productivity is higher, and policy isn't helping either. So I've been in that camp in a while, and I agree. I just wanted to throw that argument out there because it's markets are kind of taking that view a bit more seriously because they think the Fed is leaning in that direction. They're just not talking about it, or at least Kevin Warsh, I should say. So let's turn to the Fed now. You got into it a bit earlier, Diane. So tell us your views on the Fed, and you've already given a little bit of your assessment of the first two meetings, but give us some more about what you think of the direction of the Fed.
I think it's pretty clear from the Federal Reserve's perspective that the core of those who are hawkish and looking to raise rates has not only hardened but broadened. And even though it's very important to take, some people sort of responded to me, well, it was a 9-3 vote. The majority still didn't want to see rates go up at this meeting. Well, first of all, those 3 dissents were not done in a vacuum. There are many people who cannot vote at a particular meeting because of the rotation of those who vote on the Federal Open Market Committee, but their president's in the room and their participation works and they matter. And oftentimes someone dissents, not just because of someone else dissenting, but because someone can't vote to dissent. Also, the board of the board in Washington, members of the board, governors on the board, we know many of those people are looking to raise rates at least in September. They would be reluctant to vote against as a board member. That carries a lot more weight, a new Fed chairman. And so they'd want to show some solidarity with the Fed chairman right now if they thought they were going to vote in September, but it becomes much more tenuous in September, where you're going to see if the Fed does not raise rates and we do get continued inflation numbers with labor market numbers. And there's going to be some weird things going on in the labor market numbers that we should get into as well with regard to immigration. But I think those things are important because that puts the situation where you don't want to be outvoted as a Fed chair in terms of, your committee votes to raise rates and you don't. And so we won't see that. If that happens and we see a majority vote to raise rates, the Fed chair, I believe, will have to raise rates in September. And the reason they don't like to have the committee vote against them is that it's happened in the past. In February of 1986, Paul Volcker, they had stacked the Board of Governors with people who were more amenable to easing in a midterm, in an election year. That was important. And in fact, at the February meeting, when they weren't expected to do any kind of move at all of that year, they voted to overrode the Fed chairman Volcker and voted that they wanted to cut rates. They didn't end up, they retook the vote, took it back so that it wasn't that he was outvoted at that particular meeting, but they did cut by a full 2% in 1986. But that meeting he walked out of and famously said, you know, I'm going to resign after this meeting. Now, he did not resign at that exact moment in time, but he resigned in June of 1987. And the same day that he resigned, Alan Greenspan was named to replace him. And Alan Greenspan was chosen at the time in part because of what it was seen as his loyalty to the administration, and they thought he would be more amenable to policies that and less independent as a Fed chair than Paul Volcker was. That wasn't true, but that was the perception at the time. And in fact, not long after he was in office, we had a lot of things come together that truly tested his chairmanship, not the least of which was he raised rates in September of 1987. In October of 1987, we had that stock market crash, the largest single day crash since 1929. And he ended up inventing what later became the Greenspan put by easing rates to make sure that we had enough liquidity. That was a liquidity crunch at that point in time and avoid a repeat of the Great Depression. But it's very important to remember that period because that's where sort of this sense of not wanting a lot of dissent comes from, is when the board itself turns on you, when your closest inner circle turns on you, you really can't lead. And that's what Kevin Warsh needs to do, is he needs to bring the board to buy into his views, or he needs to compromise with his own board, because this is not a single-led institution. This is a committee decision, and that's something that actually was strengthened under Chairman Greenspan.
So what do you think he does?
I think he's going to have to raise rates. I think he's going to find himself in a corner. If he does not himself feel that he has to raise rates, he has argued himself that inflation is a choice. I think he missed an opportunity at the last press conference, and it actually confused not only financial markets. We saw that major market correction and the bond market react from that, but it confused the words that he was saying that were hawkish, but then the unwillingness to answer questions and trying to be ambiguous about the course of rates from here on out, when we've had inflation for so long and financial markets were pricing in a 30% chance that the Fed would move at that meeting. That was too much of a shock for financial markets. It's one thing to be cagey about what you're doing when it's unclear where the next move will come from. But I think when you've got so many within the Fed moving towards raising rates, you have to at least acknowledge that, and that inflation has been such a persistent problem. That is the situation that the chairman now finds himself. And the world that he thought that he was auditioning for, the narrative has shifted. The narrative that he saw, a year ago is no longer the narrative today. Inflation is persistent. We've got more shocks. And because of the unique nature of the economy post-pandemic, which makes it more susceptible to longer bouts of inflation and persistent bouts of uncertainty, that is something he's going to have to deal with.
Absolutely. And I've been hearing from market participants worries about the credibility of the Fed vis-a-vis the target. A lot of that is obviously centered around confusion that you mentioned. And people are just confused about what's the reaction function of the Fed. Everybody gets that, okay, the Fed doesn't want to give as much forward guidance, kind of this choreographing of near-term moves. But us Canadians are very used to living in a world of no forward guidance. Our central bank here, the Bank of Canada, allergic to that. I've talked about that ad nauseum. But the Bank of Canada does tell us what they think about the latest data.
Exactly.
And what's the state of monetary policy currently, even if they're unwilling, and honestly, for many good reasons, to tell us about what they're going to do in the near term. They lay out the risks of what may or may not happen. They sometimes give scenarios, but they try not to be biased about the future, at least. I think it's really hard to be a central banker in 2026 and not lay out your reaction function.
Exactly. And that is what people in the room who I've talked to who are in the press conference were the most frustrated about, and people in the marketplace that I talked to afterwards as well, that it's one thing to say, I'm not going to give forward guidance. I'm going to shorten the statement. I'm not going to say what's going to go on, but we still need to know what is it the Fed is looking at? What is the decision rule? And, if the economy continues to show hot inflation prints, will the Fed act on it? And how will they act on it? And that part, the if then, you're starting to see that actually come into the talk of, Chris Waller, Fed governor, he talked about if the CPI number was a really hot CPI number, that the Fed should move in July. It turned out not to be as hot. The PCE index number was hotter than the PCI number. But, he gave us that framework. You heard John Williams, who's more dovish on his policy, talk in a similar direction. Yeah. And those if then kind of statements start to give you a sense of what the Fed is thinking. When the chairman doesn't give you that same sort of groundwork to go from, that leaves the markets questioning whether or not he really means it when he says inflation is a choice. If it is a choice, some reporters in the room actually asked him point blank, then why are you choosing not to derail it now? And what is the justification for not doing anything about it now? And I think that is, one of the things that he's got a chance to reset at Jackson Hole Symposium. He could come out at that meeting, and he did leave it open-ended. He said he hadn't decided what he was going to say yet on whether he was going to talk about sort of the framework he wants to talk about and changes at the Fed, or if he wanted to talk about other issues. Well, this is a time, I think, to lay out the decision rules for the Fed. Even if he doesn't want to give forward guidance, how is the Fed weighing these issues? And I think he went in with a long time reputation as an inflation hawk. There was some question about that as he was auditioning for this role. And he doesn't want to look like he's a dove at a time when we've had 5 years of inflation, and he himself has critiqued the Fed for not dealing with it.
Yeah. I want to come back to something you said a bit earlier. And what everybody is also talking a lot about is that this comparison between the Greenspan era and the Warsh era. And I think you have a great perspective on that, Diane. And why don't you just kind of lay out what the differences are and what perceived in reality?
So there's this perception that, Alan Greenspan, if you ever move markets, he certainly was going to be on the phone and call you and say, don't move markets unnecessarily. If you're a Fed president, you could get a call from him. But he took a very long time to rein in the committee and to corral the cats, so to speak. He was getting buy-in. And his, greatest weapon, I always say, was Don Cohn, his secret sauce. And Don Cohn later became vice chair of the Fed. He was on the board of governors. He was a governor at the Federal Reserve. Don did an enormous amount of work behind the scenes to get people on the same page before they walked into the meeting. Everybody in the Fed, whether they voted or not at any given meeting, all the presidents participated at those meetings under Greenspan. But Don Cohn, what he did to diminish the level of dissent overall was that he was able to sort of corral the cats and get them on the same page so that everybody was speaking the same language once they got to the meeting. So they spent a lot more time prior to the meetings getting ready for the meeting, and then you didn't have as much dissent in the meetings themselves. It also was a period when you had just about everything you possibly could going for you. You had globalization, you had cheap imports, you had the credibility that was hard won by Paul Volcker of breaking the back of the stagflation of the 1970s. And Greenspan himself, in his own memoir, sort of reminisced that it was as much luck and circumstance as it was skill that inflation decelerated during his tenure. But that was a very different situation. And at the end of his tenure, when productivity was picking up and he was doing the growth experiment, as we'd say, where he was allowing the economy to grow and unemployment to fall more than he thought previously, thought possible before raising interest rates, he also still raised interest rates because productivity at growth itself raised the neutral rate by the end of the 1990s. So I think you have to take it in that context that he actually did a lot of work behind the scenes that made it seem like he was all powerful and the sort of sense of Oz, until you pull back the drape and you realize there were a lot of people pulling the levers and there was a lot of consensus building, but it wasn't necessarily dictating where the Fed would go. There was a lot of debate within the Fed, and it was healthy debate within the Fed. In fact, the Fed implicitly adopted a 2% Fed target on inflation before we even got an explicit Fed target. Chairman Greenspan didn't really want an explicit target on inflation, but when he was talking about going to zero on inflation, Janet Yellen pushed back and said, wait a minute, if we go to zero, that's actually the way we measure inflation. It's mismeasured. That could mean that we're actually seeing deflation in the economy, which is something you want to discourage. You don't want deflationary situation. And many people don't realize that that was all part of the debate. And he actually came off of the idea of going to zero and started to implicitly target a little bit of inflation, which was 2% back in the day. And then it became explicit under Ben Bernanke. But I think that's important to really understand that he evolved over the course of his chairmanship, which was a very long time. And Fed communications evolved as well. Remember, when Chairman Greenspan first became Fed chairman, they didn't even announce when they were done with a meeting that they had done anything. There used to be a whole profession of economists that would go out and try to figure out what had the Fed just done.
Absolutely. Times have changed, and I think they will continue to change. I think the Chair Warsh is going to have to adjust, and I think the adjustment is going to show up in September. Otherwise, the long end of the bond market is going to run away with it.
And that Ali, that really hits something home. And I know you've had some experience in Canada where you've changed inflation targets. Which inflation target do we use? There's been talk of that as well. But when the long end, Kevin Warsh talked about the long end moving up and that sort of doing some of the work for the Fed. But that's even less precise than short-term interest rates. And so your perspective on that as well, I think, is really useful in terms of what does it mean just to say the Fed not doing its job and the long end taking over? That's a much more disorderly kind of situation.
I like to say that the first rule of Fight Club is you don't talk about Fight Club. You don't stand up there after a meeting and say, look what markets did because what we said or what we didn't say. And that induced the result we want. Markets are going to adjust now.
Yeah,
they're going to know that. So for our listeners, that nominal years, the all-in yields, they rose, but then inflation-adjusted yields kind of came down. So they thought, okay, look, there's tightening in the economy and expectations that inflation will kind of get under control. But you let the cat out of the bag, and you said that.
Right.
So that you can't play that card again. And next time, I think that if you do that, they're both going to rise. So you're going to have pressure on the economy from higher long-term yields, which matters for our listeners. That matters a lot more for the U.S. economy than the Canadian economy. Canada, the 5-year yield is really the most important because mortgages are based on that. But the 10-year Treasury yield is elevated in the U.S. and 30 years rising, which matters for U.S. mortgages. So you're going to have a double whammy if you do that again.
Exactly.
Because of a lack of credibility. So that's why I think all roads lead to that evolution that you're talking about, Diane, for the Warsh regime. I'm hopeful that we'll get it, but let's see. I wanted to pivot in the last question here, something of very, very close to our hearts here up north in Canada, about USMCA. And what are your thoughts about where this all ends?
Oh, that's a hard one. I worked with Bill Daley, who was Commerce Secretary at that time on NAFTA, and it was designed for the vehicle sector. It was designed for the auto industry. And what I'm most worried about is we are already seeing additional tariffs, and the administration, the 338 tariffs that we just saw that go into effect in a week or so. We also saw additional tariffs with the 301 tariffs put on both Mexico and Canada, not as much as other countries.
Yeah.
But the real issue is going to be what happens to North American content. Right now, anything that's 75% North American content, of course, that's 90% of all goods, $2 trillion or so that goes over the borders, tariff-free. That is important. And what they're talking about doing is making 50% of that 75% US content. That is a very big disruption. If that were to happen overnight, that would be hundreds of billions of dollars in trade that would have to shift, and tariffs that would have to be paid immediately. So I don't see how that can happen overnight, but I am concerned that we've kind of put the USMCA now under annual review, which essentially makes it a zombie trade agreement. It's there, but not being enforced. And it also has been put on your annual reviews to means it can change the terms over time. That further undermines uncertainty and investment in all three countries, not knowing where tariffs are going to eventually land, because everyone is hesitating to wait to see what are the rules of the road so that I can see where I can move forward at. And I think that's where some of the biggest tension is going to be. And I worry about it because even for the US automakers, the number of times a part crosses the border before it rolls off the assembly line as a fully assembled vehicle is multiple times.
Yeah.
And that is a very hard thing to do, is just to bump that all the way up to 50% US content. You understand the desire, but they sort of behind all of these tariffs, there's this desire to turn back the hands of time. And the reality is that's not possible. We don't live in a time machine, and you can't, even if you were to get more production in the US due to protectionism in places like the steel industry, we know that that doesn't necessarily mean new production plants, and any jobs that are saved in that industry could be at the expense of other manufacturing jobs elsewhere, much like we saw during the trade war of 2018 and 2019. For every 1,000 jobs we saved in steel, we lost 75,000 in the overall manufacturing sector. That's not the kind of trade-off we want to have.
And also, you'll have higher prices and
Absolutely.
lower purchasing power for American households. So,
And it gets back to that muscle memory and
Yeah.
additional shocks and them not going away.
Yeah.
And that's something that it's much harder for the Fed to fight supply side shocks than demand shocks. This is a harder lift. And what I'm worried about is that, the Fed keeps putting out that we'll get to 2% somehow in the next year and a half or 2 years. It's out there in the horizon.
yeah.
You got to, at some point in time, actually get there and stay there. And we've not done that for over 5 years now. And more shocks are still likely in the pipeline.
Absolutely. This was a wide-ranging conversation. We touched on a lot of topics. We're so grateful for your time and your participation, Dan. We hope to have you on podcast as a regular. We appreciate you. And for our
Appreciate
listeners,
you too, Ali. So it's great to be working with you.
likewise. Thanks so much, Diane. So for our listeners, please like and subscribe, and we'll catch you next time.